On today's show, 3 questions. Number 1, are you ready for a summer slumber? Number 2, are the tariffs working? And number 3, would you like extra salt with that? Welcome to Dennis Money's 2 cents, where we help Dennis navigate all the noise. I'm Matt.
And I'm Rabih.
Yeah, you are, Rabih.
What's
You
up?
were literally just telling me, you're like, "Hey man, we've got to get the advisors on here because we're gonna run out of topics. So we'll work on that. It's tough sometimes. I'll start out with this just before we get into anything. Shout out to Jake and Taylor. They hopped on last night, so we'll have a special episode. By the time this comes out, I believe the episode will already be out. They recorded it last night on student loans specifically, and all the changes that are pretty big changes that have been made on student loans with this new big beautiful bill. And so they hopped on. They did a kind of an emergency pod and did a whole breakdown of what's going on. We don't have. There's a lot of, like all this stuff. There's a lot of stuff to still figure out, and they weren't exactly like telling you here's what you should do, but it's just giving you some information and important critical pieces to be considering. So that'll be out. And then also dentistadvisors.com/loans. And you can set up a specific loan, a consultation, and have an analysis done or get all your questions answered around loans. So don't hesitate to go there. So now that PSA is out of the way, Rabih, let's jump in. Are you ready for a summer slumber? Is this in reference to us not having enough topics to talk about?
Actually, they are related because during mid-June, July, especially in August, the market, Wall Street is on vacation, and we should be too. That is going to be
What
the
are we
slogan that
doing?
I'll carry from
What
now
are we
on.
doing?
We should be too. The Federal Reserve does not meet in August. They go to Wyoming and they do a Jackson Hole symposium, but they can't change interest rates during that time. Nothing happens. Also, most of the people are on vacation in that industry. So the usual volatility
What are
that
we
we see in the
doing?
market, I know, the usual volatility that we see in the market kind of subdues a little bit. Also, most of the big, for now, I'm taking a risk saying that, but most of like the very big steps that the administration needed to take has already done. There are tariffs, negotiation deals, passing a tax rate, a tax bill, etc. Most of the milestones of the promise campaigns are already in the books. So unless something new comes up, we should not expect a lot of headache. So honestly, the reason I came up with this question, I was like, okay, the Federal Reserve is meeting July 30th, and they might cut interest rates, they might not. The market was pricing like a 25% probability that they would. Now it's only pricing in like 5% that they're going to cut. So most probably, it's going to happen in September. The first cut is going to happen in September. So what flashed my mind was like, does it matter whatever happens from now to September? Is given that there's a slumber in August. So if we fall asleep now and we wake up September, do we think there's going to be anything that we're going to have FOMO over? I think not, right? That is the argument I'm making.
Famous last words, Rabih.
Famous last word. But
Yep.
it shouldn't be as exciting or nerve-wracking as it has been for the first 7 months of the year. That is the trajectory we are taking. With that, we got like final last positions from the Federal Reserve and from the administration, and whatever tone is set will be what drives the market from now to September. That is the type of attitude we're looking at it. So from that perspective, let's hit what the Fed's last underlying tone was. So remember when we were back at the summit, the Federal Reserve released their summary of economic sentiment, economic summary, and it said, we expect GDP to be lower, and also unemployment to be higher and inflation to be higher, but we're not changing interest rates. And we were like, what are you guys doing? Right? That was the vibe. And from their June meeting, where they did not change interest rates, the meeting minutes were released. And from those meeting minutes, there was something very interesting and how they decided to answer back that confusion that they sparked into the market at that. And here's what they said. The staff projection of real GDP growth, which they said is going to be lower for this year through 2027, was higher than the one prepared for the May meeting when they gave us the data, primarily because trade policy announcements led staff to reduce their assumptions about effective tariff rates relative to those in previous forecasts. So they were like, GDP was going to be lower. Now we think it's going to be higher simply because tariffs became deals rather than they stayed in place. The second tone that they hit is with that improved economic outlook, labor market conditions were not expected to weaken as much as in the previous projection. So now they're taking that back about higher unemployment. And then they said the staff's inflation projections was lower than the one prepared in the May meeting. Increases were expected to raise inflation this year and to provide a small boost in 2026. Inflation was projected to decline 2% by 2027. So all the stuff that they added for the summary of economic projections, yeah, we're just going to backtrack. We're going to take them away simply because the economy is not going in our direction. So where does that put us? Nowhere. We went back to where we started. Really, we went back to where we started. We think the economy is still resilient, the labor market is in check, and inflation might stay a little bit sticky or might go down. There will be a need to cut interest rates, and that's it. Now fast forward till September to see what will happen. Like, this is literally where we stand. And it's going to be we're still going to be doing 2 cents, right? I
mean,
wonder,
yeah,
hold
but
me
we got nothing
accountable
else
for
to
this.
do.
Yep, we don't have anything else. Hold me
As we
accountable for
highlighted
it.
on July 4th, we're just a couple of losers that have nothing else to do. Just hop on and
100%.
record.
Hold me accountable to that. And if there is an episode between now and September where we are freaking out about something, trying to navigate its noise, be like, but let's zoom out. Let's really think of it. Honestly, we should be thinking about this perspective of investing the whole year, right? Or the whole investment period. Just zoom out, look at the long term. And now we're going to get a chance to do it in August and September with the market not providing anything else.
So we're officially entering the dog days of summer. Everyone's on vacation. We realize we should be too. The other thing is, I'm just going to say, the Fed meets too much. Like, I feel like, right? Like, it's like too much. Like, I know that's what like the people demand at this point, or it's like the expectation, but it's just kind of dumb now. It's just like, we're revising from last month. Oh, wait, never mind. We're back. I don't blame them necessarily. They're forced to say something because we live in a world now where it's like we demand, like almost overly demand transparency. But the thing is, from month to month, with the economy being multifaceted and so complicated and all this data, like how in the world are they actually going to say something meaningful that actually, again, means anything from month to month? Am I just being curmudgeon because I'm too hot in the middle of summer?
It could be that, but it could also be that.
You're like, that is a possibility.
Yes, it could be that, but it could be that they have reports on monthly basis and weekly basis, and if nothing happens between them, their meetings are not important. But if we were in a regime where changes in the economy were happening very rapidly, think COVID, we would want them to meet at that rate or even more. Right? It's like, what is the period requiring of us type of attitude. That statement for the Federal Reserve didn't just come out of the blue. There were major improvements in, the economy is strong from a labor perspective. So we've been getting data. We were expecting, we usually create a new jobs, 144K a month, like in June. In May, we created 144K jobs. We were expecting did I say this correctly? My bad. In May, we did 1K. In June, we were expecting 1K. So we were expecting that the amount of jobs that this economy creates was going to go down. Like, this is the expectation.
And what did we get in June again?
And then in June, we ended up getting 10K. So 3K more jobs than we did in May. So that was a boost. But it's not only important to create jobs, because if you create jobs and you can't fill them, that is a sign of inflation, right? Then we got the unemployment rate, and the unemployment rate in May was 4.2%. We were expecting it to go to 4.3% for June, but we got it at 4.1 in June. So, we created the jobs and we filled them. That is economic growth. That is very meaningful, very real. And then for the jobless claims, which measures how many people are on unemployment in a sense. In May, we had 232,000 people. We were expecting that to increase to 235,000 people on an unemployment. But then the June numbers came in, and it seemed like we only now have 227,000. So it dropped. So we created more jobs, we filled them, reducing the unemployment rate. And on top of that, those who were unemployed actually got employed. So all of these are this is the data. So that is what kind of pushed the Federal Reserve to say, yeah, maybe we were a little bit too pessimistic about the track or the path of the economy. Good stuff, no?
Yeah, the economy's handing out jobs like Oprah, right? You get a job, you get a job, everyone gets a
Except
job.
fresh graduates in computer science.
I was gonna
RIP to
say that is the rough
them.
part. Did we talk about this
We did talk about
on
that.
here? Yeah, how they're the all-time low for Harvard and MIT and these elite colleges for it's kinda wild. Like, the CS programs just can't place anybody.
Yeah.
That's that's a bummer.
It's wild. Actually, just today, it was a headline on the news. It says that Goldman Sachs is piloting its first autonomous coder in major AI milestone for Wall Street. So we're probably gonna go back to people who know how to talk versus people who know how to code on Wall Street. We'll see. We'll see how that
Yeah.
changes the industry going forward.
Yeah. So, all good on the economy front.
All good on the economy front. What I want to hit with you, and I think is more interesting, is the behavioral aspect of it from a investor perspective. Whether professionals like us or people who are just listening to the podcast and they love to day trade.
Professionals like you, and then I'm here as well. Yeah. Yeah.
The idea is just like we move from one regime to another regime in the economy, where like high inflation regime to no inflation, high unemployment to no unemployment, etc. Regimes of panic versus no regimes of panic. I think we might be moving from a fear regime to a greed regime. This is what I'm thinking of.
Mhm.
For the past couple of months, our attitude is like, oh, what happened? What was released regarding tariffs? Should I be doing anything about the portfolio? What should I go do now to tweak it, to make sure that, my portfolio is corrected? Do I sell at the low? Like, those are the panics. Those are the first thing that flashes to your mind as an investor. Going forward, now that suddenly we're expecting the storm to calm down, to them to be on vacation, if you stay in that same mental block of like fear, what should I be doing about the portfolio? We're not going to be seeing as high returns. Like the standard deviation mathematically has reduced, or the VIX in a sense have really gone down. So the 4 or 5% moves that you would see in a typical month in 2025 are now going to be a 1% move throughout the whole month. It's going to go up a little bit, go down a little bit. We're not going to see those big days unless new significant data
Something
shows up.
changes, yeah.
So when you're still behaviorally locked in that perspective of what should I do? What should I do regarding these big moves? And now you're only seeing smaller moves. You'll be like, okay, those moves are too small. I need to change something in my portfolio so I can get the return. And just because that's, what's that bias? Reference bias or a recency bias.
Oh,
Just
recency
because
bias, yeah.
psychologically you were in a state where you wanted to act quick on your feet, and now there's nothing happened, but you still want to be quick on your feet, you might be over optimizing, over tweaking, touching your portfolio when you should not do. And this is where it happens. Like the market is not going up. What if I take a little bit more risk? Uh, you know, I stay at a very fast rate of return, higher
Yeah.
rate of return. I think this is the most important part. A lot of money is lost, not when the crash is happening, but when nothing is happening and people leverage up, and then something happens before they can unwind it. And this is the shift, I would say. Another parallel is during the first Trump administration, 2016 was, volatile, just because a new administration is coming in. It's the same playbook of like attack first type of negotiation politically. And then 2017, nothing was happening, and the stock market was inching up down a little bit by a little bit. The stock market still did well, plus 20% for that year, but people were leveraging up. And then when 2018 came in and they were fighting with the Federal Reserve, and the Christmas, panic in 2018 happened, people lost more money than they were supposed to just because they were over tweaking in 2017. So this is the behavioral journey that we're going through. It's not that, oh, history is going to happen, it's going to repeat itself. No, but our patterns, our behavioral patterns are more probably than not fall for the same mishaps if we don't have the awareness of it.
Yeah, it's a great point, Rabih. I mean, you're bringing up the two sides of this, which is like the spreadsheet, the data, the facts, like what's happening in the economy. But this is why finance will never be necessarily like a hard science, right? It's not physics because it's comprised of all of us humans that have emotions, and we're greedy, we're fearful, and that impacts our behavior. And when you were going through that, I couldn't help but think of this concept from Morgan Housel where he talks about and I'll paraphrase, I don't have it in front of me, but where like every bull market plants the seeds for the next bear market and vice versa. And it's what you're highlighting is it's the behavioral side. It's we come from, like you said, this period. I mean, just this year, Robbie, we're seeing it just this year, this Jekyll and Hyde and the years, we're halfway through the year. We literally had 3 months of absolute chaos, and people were freaking out saying we're going into the next depression or World War III. I'd love to see the Google searches on that this year. um, to then periods like now we're in a period of like everyone's just kind of chilling, and it's like business as usual. And the worry is, does that almost lull you to sleep and it leads to that next big move? The thing I've been thinking about is because there's so much crap coming out at us from like, we're going to go into the next topic here of tariffs. I've actually been thinking like, do we almost get numb to the, like everything is breaking news now, everything. But like one of these days, something really is going to be breaking news and actually have an impact. And like, we won't even know what that is because everything is breaking news. So it's almost like we're becoming, to your point, almost becoming so lulled to sleep that we start to like lose track of like the risks we're taking, and it doesn't feel that risky because we become numb to this news. So I guess the idea or the question here is like, what do you do? We're saying in this period of time, just like earlier this year, we're not saying don't overreact to what's happening, navigate the noise. Now we're saying pump the brakes. There's still all the same risks that have been there. This is not an environment where you can go leverage or double or triple down because you think things are safe. Thoughts, Robbie?
No, I love it. It's really like if your hand has been under cold water for a while and you decided to go hold an ice cube, you will not feel it as much. And this is what we are into. Like this is the environment we're in. And in our situation, the market has been the last 2 months have been great for stock markets, like in the top 90th percentile of best performances that has happened over a 2-week period or a 1-month period, etc. And we don't need to be attached to those. We're going to go back to just moving 0.5% a month, and we should be fine with it and not over optimize on it.
Yeah. Yeah. And we've seen that already. I mean, the S&P this year, I think, Robbie, 20-point
7,
swing, but I'm saying a 20-point swing this year, I think.
yeah, 20.
I think it was
20
like an
points.
intra-year 12 or 13% drop, and now we're up over 6 or 7%. It's kind of crazy. We've seen literally an intra-year 20-point swing just on the S&P. So, okay. Anything else, Robbie, you're calling your shot. You're saying no volatility and nothing going on for the next couple of months. Is that what we're saying? Is
Yeah,
that the point of this?
I think it's gonna be boring, and we need to change our mindset from knowing how to deal with panic to knowing how to deal with boredom, because it's a double-edged sword.
Yes. And both can be hindrances to the ability to build wealth for sure. Sometimes I'm more afraid of people getting bored because that's where they start to make really dumb decisions. So, okay, let's move on to the tariffs. Robbie, I think daily lately, it's like we went tariff crazy, the tariff tantrum. Then it kind of like subdued and slowed down, and everyone was like, oh, he's backing off. And now it feels like we're back to like every single thing that comes across my computer of like news and headlines is new tariffs. Is this just a result of the big, beautiful bill is now done and now we're back to tariff talk? Is that what this is?
Probably. Also, maybe remember we talked about July 9th, which is supposed to be before yesterday, a deal with Europe, and that didn't happen. So maybe now we are distracting people about a failed part of it. But it did work out with China. It did work out with the UK, right? It didn't just work out. It could be all of these. And, the administration has an agenda and it's pushing it. Let's see where that takes us, right?
So the question is, are they working?
Are they working or they're not working? Honestly, I like to report on when tariffs get released, but I've been like trying to update my 2 cents topic or like information in it every day. I wanted to talk about Brazil's 50% tariffs, but I woke up this morning and there's 35% on Canada. I was like, I can't keep up. I
That's what I'm
can't keep you
saying.
guys up to date. But what we have is the impact of tariffs on the budget, right? I think a big part of the plan was we're going to increase tariffs to bring in money into the US government in an attempt to reduce the deficit and hopefully balance the trade deficit, right? And we got some data on that. And we got the data for April and we got the data for May, which are important because April is when it was announced. And this data is the US budget data. So we know that over a year we rack up 1.7 trillion in debt, right? Type of thing. That was the last reading. That is the deficit
I
that
love how cavalier we say that now. Like, yeah, we know we're gonna get about 2 trillion in debt. No big deal. Just put it on our tab.
I know, but we're too drunk to notice that. I do not know how we're gonna walk out of
3
that
a.m.
bar.
We're at the bar and it's like, whatever, dude. Drinks for everyone. Who
Yeah,
cares?
yeah. I don't know who's gonna pay for it, but probably my kids are gonna be washing dishes for a while. Like this is
Exactly.
exactly the scenario the U.S. is in. So every single month we can calculate what was the saving versus deficit that we went through every single month. So in April we actually had a surplus. But it's fine. Like, don't think that if we had a surplus in 1 month, it means the year is going to be positive. It's just one blip.
We solved it.
Also, April is
solved
a
it.
tax month, right? So there is a very specific seasonal thing regarding to it. So let me start with that. In April, the US government posted a 258 billion budget surplus. It is up 23% from the same month last year, driven by strong tax receipts and higher import duty collections. So this gives a check mark to tariffs them working. The surge came in during the final month of the tax season, when revenue typically peaks. They go into the details on like what was the cost, like not custom duties, 16 billion for the month. It's a $9 billion increase, and it was mainly because the tariffs on China during that month were like 145%, right? Those are the stuff. But I think the important part for it, on average, and this is the data, on average, the US collected over $500 million per day in tariffs during April, although this is down. Yes, although this is down from the $2 billion per day President Trump claimed previously. So this is interesting because if we want to say, did the tariffs work for the month of April? We said they did, yes, but they did not do the extent that we want them to do. They only worked a quarter way to our goal, $500 million a day instead of $2 billion a day. And now we have the data. Now we see, like they were arguing, the administration was pushing something with its own economists. Other economists who are on opposing side were pushing for something else. Some people are saying this is going to increase the deficit and this is going to be worse for the month. I know 1 month is a very short period to look at it, but the perspective that they did not know, now we have the final result of the battle. Tariffs work. They increased revenue to the government, but not as much as they did. And now going into other months, we're going to see the impact of those side effects that the tariffs created and whether that aligns and further supports the narrative of tariffs working that was established in April, or will completely revoke it. So let me move to May.
So we only have April. Oh, you were going to May. Okay.
I have April and I have May. So with May, now we got it. The US government recorded a 316 billion deficit, not a surplus, but a deficit in May, down 9% from a year earlier. So we borrowed less than we borrowed in May.
The deficit did get improved.
Yes, driven in part by a surge in custom receipts to a record of 23 billion due to new tariff imposed by President Trump. Gross custom receipts jumped 6 billion from 6 billion. Let me find you the good sentence.
Find me the good stuff, Rabih.
Find you the good stuff. Year-to-date customs revenue rose nearly 60% to 86 billion. This boost helped push May's total receipt up 14% year over year. But here's what we need to look at. After adjusting for calendar shifts related to June benefit payments, the adjusted May deficit was 217. So a 17% drop comparable to 2024. So it's not only didn't improve by 9%. If you adjust for other factors, it improved by 17%. But I think the important sentence out of all of this is that interest on national debt, the government's largest expense, also fell 10% from a year earlier to 92 billion. The first decline since October. So what does this tell us? To change their English to more comprehensible English, the tariff impact, the carryover effect is still positive. It's not as productive as we thought it would be, but now the deficit that is happening every single month is slightly less on the front of, and that's due to how much money we are bringing in. The tariffs came in, prices got increased. Remember, we were at the restaurant on Wednesday, and it was like, have
Yeah,
they always been this
I had
this
to explain
expensive?
inflation to you
Yeah,
because I
yep.
know you don't fully understand it.
It's a completely foreign concept to me. So it's
Yeah.
like at that point, I was like, okay, everything's getting more expensive for Americans. It's not like over rampant inflation that causes spiraling effect, but there's a jump in price levels, and U.S. consumers are still going to consume. So
Of
even
course.
with higher prices due to tariffs, we are just funneling more money into the government in the hopes that this will reduce deficit going forward. There have been improvements, but this is like you have a virus and you're only taking Tylenol. Like, it's good, the tariff is there, it's making an impact. Now you can open your eyes and have a chat with people who are not sick in bed, but you're not gonna get healed. This is not a long-term solution. I'll take it. It's economic gain, but it's more political than it is economic. We'll see going forward whether that trend continues, whether the budget month by month actually improves, or at least the deficit lessens month by month until we get to the end of the year and really get the full picture about tariffs. We've been talking about it since January, right? Now we are at a point where we have data to see which side we are falling on. The conversation on the news, on the media could have been completely different if, the deficit has been ballooning instead of it being. We'll see now when we add this deficit impact to the one big beautiful bill impact and see whether we just go back to the previous level. They cancel each
I was
other.
gonna say just set
Yeah.
it all backwards, yeah, depending on if you look at the reports that are all bipartisan, all kind of down the middle, all the reports are stating that the big beautiful bill as of now will add 3.8 to $4 trillion over the next 10 years. So you're right. Maybe all of that gain will be just wiped away with this tax bill. The other thing I'm thinking, oh, go ahead, Rabih.
Go ahead.
I was just thinking, you said something interesting that I think would be an interesting mental exercise. No way to prove this, but just want to get your thoughts. When you said we went to lunch the other day, and you did say you looked at it and you were like, "Is this?" So for full context, we went to the Post Malone Canes. For those of you that don't know, Post Malone lives in Utah. At least has a house here, and he has a Canes restaurant that is a Post Malone Canes. He's designed it all, and so it's kind of become like this little kind of a. Literally, clients will ask us sometimes, like, "Oh, you're in Utah? Have you gone to the Post Malone Canes?" Kind of like a known thing now.
It's cool. That was my first time visiting. It's
It is
really
cool.
cool.
Yeah, it is cool. But you walked in and you said, "Man, is this just more expensive because it's Post Malone's, or like, is this how much it costs?" So when you were going through all that, it made me think. Let's say we knew for sure that, let's say the tariffs were working to the point of creating surpluses every month, and we were like seeing substantial decrease to the overall debt. I'm just saying, just go with me for a second. But the result was the end consumer had prices increase noticeably. We saw, I am genuinely curious what the response would be from people.
Be political. That's a very good point, because you've got three portions of the economy. You've got the consumers and businesses, you've got the government, and you've got the rest of the world. There is debt. Someone will have to pay it, right?
Someone has to pay. That's how debt works.
Yeah, the administration is saying that with tariffs, they'll make the rest of the world pay it. But that's not the case, because if you and I are in that bar, and just to keep that analogy, and we're just adding to the tap and adding to the tap, the Chinese group that are drinking on the bar next to us, they don't have any obligation to pay our tap, right? This is exactly how it is. Like, the US has been borrowing. There are other people in the bar, but no matter how much stronger you are than them, you're not going to force them to pay your tab, right?
Yeah.
That is the analogy. So who's going to pay? It's either you're going to figure out how to pay it and maybe hurt your own pocket because you have to pay that tab, or, which is a feature of economics, tell them, okay, I will take a debt that my children will pay later on just to fulfill your tab right now. That is the idea. So who's going to pay it? And in most cases, unless, there was a big government, in all cases, because the government is just, the aggregation of the citizens, right? The people end up paying it. Will they pay it by a higher ticker, or will they pay it through other macroeconomic measures that we do not see? And I'm so glad you mentioned this. I was reading a book yesterday about the tariff period in the 70s, etc. The argument was that in the 70s, 80s, it was against Japan. And the argument was there is a big trade deficit between the US and Japan because now the US has had a strong dollar, and from the perspective of foreign buyers, US products are not attractive. The dollar is too expensive. So what we need, and this is what the government did, deliberately lowered the value of the dollar in the hopes that the American produced goods are going to be more appealing to foreign purchasers, and they will start buying more American, and that will improve our deficit situation. That was the conversation that was happening in the 70s and 80s. What happened when the dollar dropped? Inflation showed up. Two sides of the same coin, because your purchasing power is getting reduced. Right now, the US dollar is at the lowest point it has been in 50 years. And that is when what thing was happening. Let me pull them up as we speak, or
I was just going to say, while you're doing that, Rabih, you think inflation was bad over the last few years? I don't think we even grasped the actual what inflation really feels like or comparing it to the 70s and 80s. The true hyperinflation we experienced during that period of time. It's not even
100%. I actually got some numbers. Currencies are like they move, but like they move by 2%, 3% for the whole year, right? So far, the US dollar has depreciated against the euro by 11.4%.
this year.
That's a currency, yes. So when we are looking at developed market performance and we're saying, yay, it's up 20% for a US consumer, 11% of those are coming from currency. Not just because European companies are producing really amazing returns and they're returning high profits. No, there are two sides to that foreign return.
So they could be stagnant as economies.
Yes.
But the currency difference, the differentiation between currency and the movement between currencies can almost show an overinflated sense of growth in those economies.
100%. So just because we hit 2 points over here, from the investor's perspective, a lower dollar, especially for a global investor, a US investor who has a global diversification strategy, who they invest in in foreign stocks, a lower dollar is really good for them because that is going to increase and enhance their foreign return. For a US consumer, a lower dollar is going to be tough on people because that will reduce. That is kind of inflationary. It reduces their real purchasing power.
Which I think is the definition of inflation, right? I mean, people think of inflation as higher prices, but at its core, inflation is just lower purchasing power.
Yes.
So the weakening of the dollar truly is inflationary. Like you said, it lowers your purchasing power.
Yes, but the lowering of the dollar, as we are seeing, does not necessarily mean that tomorrow the price tag is going to be more expensive. There are lags. There's companies in the middle in that chain reaction who have a little bit of control. They could delay the effect. They could be, because for those companies, example Walmart, who's getting a lot of their main goods elsewhere, their CFO is sitting there somewhere trying to preserve their revenue that they are making and try to lessen the impact of this currency change as much as possible. And that usually protects and shields the consumers for a certain period of time. But if the US dollar stays as weak as it is and the tariffs are staying in place, there will be at a point where the companies in the middle are going to be passed through rather than shielding, and we will see more prices hitting the US consumers. This is following exactly the textbook
of the 70s and 80s that you were reading.
Yes.
Well, more to come.
Yeah,
we'll be here. We'll be here either way to talk about it on the show.
But this is not like doomsday or whatever. We've dealt with it before, right? It's not doomsday. It's just, okay, we move from one risk to another, and that's the one that's showing up.
Wait, Rabih, you're saying we're not living in unprecedented times? Because I feel like every day, that's what I'm being told, is that every day is unprecedented. Interesting. And everything is breaking news. everything. So if everything's breaking news, then nothing's breaking news now. And if every day is unprecedented, then no days. So then I think they're all precedented. So it just baffles me.
This is an unprecedented podcast.
We are an unprecedented podcast offering breaking news every week. That's what should be the new intro. Okay, last topic here. We were messing around with questions. Rabih was helping me with this. He didn't like my first one. We won't say what it was. But would you like extra salt with that, Rabih? Did you like where it landed? You like where that one
A
landed?
foodie, I'll always
The
add
salt?
salt. Yep, it
Yeah.
adds flavor.
Okay, wanted to talk. This has to do with the big, beautiful bill everyone's talking about. There's so many changes and things to highlight. One of them that certainly will impact a lot of our listeners being what I should have actually led with this. One CPA called it the salt torpedo, which is it's kind of interesting, kind of like that. So, oh man. Anyway, so Big Beautiful Bill, it has created a temporary higher limit on the federal deduction for for state and local taxes known as SALT. So this has been a huge impact over the last few years. Many of you out there listening know this by now, I'm sure, that there was a cap at $10,000. So this really, really impacted cities and area states that had, so think of New York, think of California, these areas that had high state and local taxes. When you were capped at 10,000, that had a massive impact on some high earners that were itemizing deductions. So there was this workaround. Again, I'm sure many of you have heard this, or maybe you've talked to your CPA about it. That states, I believe it was Minnesota, Rabih, I believe was the first state to enact this, or somewhere in the Midwest, to have this workaround, what they call pass-through entity workaround. So a lot of dentists have been using that as well. But what with the new big beautiful bill, they've got to come up with a different name. We got to call it something different. Could you call it BBB? The BBB?
Yeah.
Okay. Not to be confused with BBL. BBB has temporarily raised the SALT deduction to $40,000 starting this year, with a 1% yearly increase through 2029, but then reverting back to 10,000 in 2030. It again, I think this is all part of the reconciliation, the back and forth. They wouldn't allow to make this permanent. So here's the wrinkle though, Rabih. So the $40,000 SALT cap starts to phase out at a modified AGI that exceeds 500,000.
Okay.
So from 500,000, it's fully capped and reverts back to 10,000 at 600,000 of modified adjusted gross income. So that's why people are calling it an artificially high tax rate, or again, what this one guy called it, a SALT torpedo, because when your AGI falls between 500,000 and 600,000, that SALT deduction now torpedoes, as he calls it, and goes back to the 10,000. So I'll
go
stop there
immediately to the 10,000, or is it in between the 40 and the 10,000?
Yeah, so I can kind of give you, I think it breaks it down here. So it says between 500,000 and 600,000, you're losing 30% of every dollar. The benefit between those thresholds.
Looks like a slide.
Let me see.
Torpedo, right?
It is like a slide. He's calling it a torpedo. It's a pretty tight window, though, right? Of that, 100,000 is a pretty tight window for that to drop off completely. I actually don't really know the intent behind this, the congressional intent of having this SALT deduction, back to the higher limits, but then capping it in between what is it between those incomes? I really don't know. But just a wrinkle, something to be considering with your CPA. There are some, I think, some good things, some positives that for dentists out there. Things like the QBI deduction is now permanent. Obviously, they've kept the tax brackets from 2017 lower. They were set to be reverted back, and that was going to make a big deal, or be a big deal. But I think this is actually probably an underrated piece of this. Probably something to be keeping an eye on as a dentist, and be talking to your CPA about. That if you fall anywhere in this range, this could be a big tax surprise for you.
Yeah, 100%.
Any thoughts on this, Rabih? I know, for you, you're well over that limit. So you're going to have to find a way
Yeah,
to
I'm
cut
one of
down the
these
income.
billionaires that never pays taxes. I'm one of
You
these.
what?
I'm one of these billionaires that never pays
Yeah.
taxes.
Yeah.
You know them? Yeah.
You are the people that people gripe about online.
Yep,
You
100%.
are that phase. Exactly.
Honestly, something that came to mind, I wonder whether those thresholds and cutoff numbers are a result of, an economic analysis where they decided to find a formula and see where, this is the income range that separates the population between this group of earners versus that, or it was as a result of political negotiations, aka the Republicans and Democrats, or Republicans between each other, because the Democrats didn't vote this time. We're sitting there and they were like, let's set the market people making above 500, or no, let's make it 300 or 600. And they went back and forth.
Had
I'll
to have
give you
been.
here, you'll give me there. And they ended up with that number, which makes it arbitrary. If it's a result out of political, push and pull, then it's arbitrary. And then we're going to be waiting and seeing what the economic impact is.
Yeah, for sure. Let me just give you it actually this article breaks down a pretty basic example. I know it's always hard to hear numbers on a podcast without visuals. Uh just to give you an idea, Rabih, see if this tracks. So take one dentist A that makes $500,000 in adjusted gross income. They subtract $75,000 of itemized deductions, which includes 40,000 from the salt, right? So a total of 75,000. Their taxable income is 425, right? Pretty significant savings. Let's say you made 600,000 of income, your salt would drop back to $10,000 cap. So that reduces that same 75,000. Now you're down to 45,000, and that raises your taxable income to $555,000. So it's basically what they're saying in this simplified example. It's a 45,500 more federal tax owed on that $100,000. That's a 45.5% tax
Mm,
increase on that
it is steep.
100,000. It's
Yeah.
pretty steep. That's steep. That's significant. So a lot of things to be considering there with your individual situation, with your tax advisor, how you again can reduce that AGI if you're in that gap, in that
I'm
window.
I don't know. I'm talking from the perspective of investments because I do not know much about taxes, but I'm guessing now if we look at clients who are making less than 500K versus those who are making 600K and more, the 600K and more are more incentivized to do charitable donation this year, much more to reduce their AGI, right? I do not know what are other stuff in the works. Maybe I know, but I don't want to speak and be wrong about them.
Yeah.
That would lower the AGI further, but I think people will start taking a bigger look at that.
For sure. I think that's a good point. And then also, I don't know I need to talk to our CPA contacts and maybe we can do some more content on this, but where the pass through entity workaround still, if that still works in this situation, because if that does, this might be a bit of a moot point, but just something to think about there. So, Rabih, any other words of wisdom or anything else you want to add to anything we've talked about?
I don't know. I just want to go full circle and tell you, yeah, there are changes, but please enjoy your summers, everyone.
There you go. Go vacation. We're not going
Really,
to, but you should.
we're here. We'll give you
Yeah,
a call if there's something that requires your attention, but go
there you
enjoy
go.
life.
Exactly. And if you're still here with us, we appreciate it. If you're still listening, we really appreciate you listening. If you found it helpful, we'd love for you to share the episode with a friend, someone you know that this might be beneficial as well. And if you want to talk to us, we are always here to talk. We love talking to dentists all over the country. You can go to dentistadvisors.com and click on the book free consultation button. You won't get lucky enough, most likely, to talk to Rabih, but you will talk to one of our friendly advisors. We would love to chat. So for now, again, thanks for listening. Rabih, thank you for being here. That was our 2 cents. Till next time. Bye-bye.